Hello, everyone, and welcome to our 2020 Economic Forum. I am Ron Hume, Executive Vice President and Portfolio Manager, and will be the moderator of our panel discussion today. Thank you for taking the time to listen to our perspective on the economy and capital markets. As market valuations continue a run of unprecedented volatility in reaction to the COVID-19 pandemic, our entire team has been focused on managing client concerns, risk tolerances, and their investment portfolios through one of the fastest and deepest market corrections in history. Our purpose today is to provide more clarity around these uncertain times that we are all experiencing. Due to the recent Center for Disease Control recommendations, our presentation today is being recorded via our mobile devices, with each of the participants practicing social distancing and calling from their respective home offices. Our subject matter today will cover the state of the economy and our forecast, turmoil in the equity markets, and then we'll focus a little bit on the fixed income markets. Our panelists and to present their views today, and I will ask them a few general questions, and then to wrap it all up, our president, Bob Kincaid, will close with his perspective. So on the phone with me today are Dr. Dan Laufenberg, Chief Economist for Stonebridge Capital, Bob Kincaid, President and Founder, John Schoenberg, our Chief Investment Officer, Heidi Huckreed, CFA and longtime portfolio manager, John Lynn, our Senior Fixed Income Analyst and Portfolio Manager. So if we may, let's get started. Dan, take it away.
Thank you, Ron. My goal today is to give you a very brief overview of what we think, where the economy is and where we think it's going. The bad news is that we think the U.S. economy is in a recession. It's going to result in higher unemployment, lower inflation, lower profits, near zero risk-free interest rates, and wider credit spreads. Some of these things have already occurred. We have the Fed pushing rates to credit risk-free rates to near zero levels. You have credit spreads widening now, but we still haven't had any information yet on unemployment, inflation, or profits, or economic growth, for that matter, to suggest that it's a recession. So there's still some information that we're going to be gathering over the next few months to determine whether or not this is a recession, or whether or not, and to the extent how long it might last. Former Fed Reserve Board Chairman Ben Bernanke expressed the view that the recession will be short and shallow compared to other recessions, especially the last one. I agree, but there may be a difference of opinion about how short or how shallow that this recession might be. If it's a very quick, very short recession, the recovery is going to be very quick. That's different than one like the last time, where the recession lasted for a considerable long time, and it was very, very severe. We think that this one will be relatively short, relatively shallow. I don't think it's going to be over in a month or two. If you look at the forecast that we put out recently, we do have a recession lasting roughly around 6 to 7 months. So it's the second quarter, third quarter of 2020 where you actually see a decline in real GDP. You actually look at the recovery starting sometime later this year. So it is going to be relatively short, regardless of who might be making that prognostication. And it is likely to be relatively shallow compared to historical averages. There's little doubt that the U.S. economy is struggling markedly at the moment due to the shock of the COVID-19 virus. This was evident in the data reported in the last couple. This will be evident in the data that will be reported in the next few months, including higher unemployment and declining real output. So I think it is a recession. It's going to be more obvious that it's a recession once we get more data, but it is just at the beginning of the process. Are these going to be temporary setbacks? I don't think they'll be as temporary as some are hoping. I do expect the economy to be in a recession for a while, as I mentioned earlier, probably around six months. It was sort of interesting that at the beginning of the year, and in fact until now, we really haven't had any economic data that suggests that we are in a recession or that recession was forthcoming. And it was sort of a shock, which is usually how these things occur. It was a shock to the economy that the recession began so soon. In fact, it was a bit of a shock to me. I expected a recession, but I thought it would be starting a little later this year, not right now. And in large part, that's because of the coronavirus that we experienced. The evidence of the recession was suggestive back earlier this year when we were talking about a recession. There wasn't any hard data to support it. And by suggestive, I mean there are certain indicators that we look at that would provide us some guidelines, some insight as to what is going to happen to the economy. The two variables that I look at, that I have looked at historically to help me in this regard, have been the inverted yield curve and the LQ indicator. The inverted yield curve, basically what happens is when short-term Treasury yields rise above the longer-term Treasury yields, the yield curve inverts. The spreads actually turn negative. And so this is a indicator that a recession is probably forthcoming. This has been a very reliable indicator in the last 40 years, at least 50 years at least. So you can almost guarantee that at some point there's going to be a recession. The question is, how soon is that recession going to occur after the yield curve inverts? So for that reason, I had a recession in the forecast coming sometime later this year. Also the LQ indicator, which is a proprietary indicator that I have developed over the years, suggests that the recession was going to be coming sometime this year as well. We thought it was going to be sometime around the middle of the year, which is why we had the recession starting at that time. So both of the indicators that suggested a recession was coming actually were giving us that signal before the coronavirus was even on the radar. And it was sort of interesting that the coronavirus was sort of the shock that triggered the recession to begin. And the interesting aspect of this is that the coronavirus probably, I don't think it replaced the recession effect that we were looking for, but what it did is it probably caused things to, the recession process to accelerate so that it was more front-end loaded. A lot of the bad news from the economy is probably going to be in the second quarter, less so in the third quarter, and then by the fourth quarter we actually see the economy starting to improve again. And then, of course, this is assuming that there is no reinfection due from the virus, that it goes away in the summer and then comes back in the fall. So this is the forecast that we have. Obviously, the surge in government spending and the unprecedented steps taken by the Fed to provide liquidity to the markets will certainly ease the economic pain of the virus. But I still think that the recession is going to be in place long enough so that the economists at the National Bureau of Economic Research will have an opportunity to declare this a recession. But don't hold your breath, because the National Bureau of Economic Research will probably tell us that the recession started in March of 2020, about the time the recession is over. So it'll be a while. An example of that is the last recession. It was in December of 2008 that the National Bureau of Economic Research told us that the recession began in December of 2007. Now the question is, will the surge help? Yes, it'll help ease the pain. The question remains whether it will be enough to restore the confidence needed to get households and businesses spending again once the COVID virus is subdued. I think it takes longer than most seem to be hoping it will. Indeed, the consumer will be the key here. The consumer is very important. Consumer spending will decline due to the disruptions in consumer spending, consumer behavior due to the virus. In this particular case, spending on services probably took the bulk of the hit. Now, goods spending will eventually suffer as well, but I would argue that the bulk of the damage here, at least early on, will be in the service sector. The question is whether consumer spending will improve again, but when and how much. So I think it will improve, but when will it improve? Unemployment, which is likely to jump in the months ahead, will create a great deal of uncertainty on the part of consumers about their future finances, such that even those consumers who can afford to spend will hesitate to do so. So it's not just the people that lose their jobs or lose their income or are being compensated somehow with the federal programs. It's even the people that have the money, have jobs, that can afford to spend will cut back. Not until that uncertainty starts to wane will consumers increase spending in any meaningful way. There's an interesting survey conducted twice a year. It's actually conducted by the Census Department for the Bureau of Labor Statistics. And it's the most comprehensive survey of household incomes, expenditures, and saving. And this the most recent number that we have is for 2018. But what was really interesting in 2018 is that the middle income group, those people that were considered middle income, they actually were spending all of their income. Their saving was near zero. So the question is, how much of a cushion did they have to withstand a shock like we're experiencing now? And the answer is probably none. And so these people are going to be cutting back dramatically as they lose income, or even the fear of losing their income will be a factor. So it'll be interesting to see how this plays out. It may take longer for this group to recover their spending because of the fact that they didn't have much saving to begin with. Housing demand will suffer somewhat during the recession, but nothing like it did last time. In the last recession, housing was part of the catalyst that sort of triggered the recession. It's not so this time, and so it will suffer. But I would contend that it will not be a leading factor and probably not suffer nearly as much as it did last time. In fact, if the recession is as short and shallow as we suggest, it may not show up in any significant way in housing. The Fed obviously responded very quickly to the concern about the coronavirus and what its impact might be on the economy, on liquidity. They cut interest rates dramatically. They went from basically 2% to zero in a very short period of time. The most recent move being quite dramatic on a Sunday evening, which was very, I think, disturbing to many that they acted so aggressively outside of a meeting. But nevertheless, they cut rates. They were doing what they felt they had to do. They implemented quantitative easing once again. They actually developed some special lending facilities that make it easier for businesses and banks to basically acquire the liquidity that they need to continue to do business. One could argue that, in fact, the Federal Reserve has been so aggressive at setting up these lending facilities that they effectively have taken taken over the business of commercial banking, that they are now the lender of last resort, not just to banks, but the lender of last resort to everyone. The Fed, by expanding the list of items it will purchase, it's going to be high quality, so all the good stuff is going to be basically owned by the Fed as a result. And so it provides the liquidity, but it doesn't really do anything to solve the virus issue. The Fed is still going to be pushing on a string, sort of, but they are there. They are available. They're going to make sure that they do their part to try to ease the pain of this recession. The federal government stimulus package, we think, is forthcoming. It looks like there's been an agreement reached in the Senate. It's a $2 trillion package. We don't have all the details, at least I didn't at this time. But it looks like it's going to provide payments to taxpayers. It's going to provide loans to small businesses, and it's going to create a $50 billion corporate bailout fund. It's also going to provide relief to state and local governments, some relief to hospitals. It's going to provide some relief to, it's going to enhance and extend the unemployment compensation programs. So it's very comprehensive. It covers a lot of different areas. And the question is whether it will be enough, of course, because even $2 trillion isn't 100% of GDP. It is a lot. So it'll be quite interesting to see how it plays out. You can give people money, you can give them an opportunity to, the wherewithal to spend, but you still have to convince them to spend. And if there's uncertainty out there, it may be difficult to do. So again, it'll be very important for the Fed to help bring down any fear. So the bottom line here is that the recession is in place, we think. We think it'll be relatively short and shallow, maybe not as short and shallow as many hope. I think it will last through the third quarter. The recovery will begin in the fourth quarter of 2020. Unfortunately, it will be a very slow motion recovery once again. Our economy isn't really equipped to handle those sort of rapid recoveries of old, even if the government is there just pumping money into the system endlessly. So I would expect that this will end. So the bad news is it's a recession. The good news is that it will end. This reminds me of a story. People like to have the economists come and tell them when things are bad. They like the economists to come and tell them that it's not going to last forever. But the last thing they want when things are good is an economist coming and telling them it's not going to last forever. So I guess my message today, it's not going to last forever. Let me turn this over now to John Schoenberg, Chief Investment Officer for an assessment of the equity market.
Thanks, Dan, and thanks for your comments. I will say that the equity market has been in turmoil. I think everybody is aware of that. The news channels make sure we all know that it's record down days or record up days. Given the level of volatility, every day is a new day, and it's fascinating how quickly the markets have moved. Part of the issue that I think all equity investors have today is that you've essentially shut down the U.S. economy in many different ways, but you've left the equity markets and the fixed income markets open to trade. And I think it's very difficult for people to wrap their heads around what the future is going to bring when everybody is staying at home, working from home, not traveling, not going out to restaurants, not going out to hotels. It's created a really interesting market environment and a very difficult one because you don't have much information on what companies are going to earn given the level of shutdown that we've seen. So it's a very challenging environment to try to manage money in, to say the least. I will say the good news at Stonebridge is we did listen to Dan, as unpopular as it was to forecast an end to an economic cycle that was all good for a decade. But we started really last summer moving our clients' portfolios to a more conservative investment posture relative to their own individual investment objectives, and that's paid off. Many of our clients are in much better shape than they would have been had we done nothing over the last 12 to 18 months. And again, this is a process. We don't manage money all in or all out given on a given day, but we make incremental moves. And I think we have made many of those moves over the last 18 months in preparation for a slowdown in the economy. Now, it's happened much quicker than any of us thought it could. We did not see the coronavirus coming. But it is the factor that, as Dan said, is tipping us into the recession. And, what do we do from here? I think while our clients are in good shape and we've protected a lot relative to their own individual objectives, one problem is it never feels like enough when we're in periods like this. We've reduced equity positions. We've made more conservative equity investments inside of equity accounts. But when you're going through the decline, everything is still going down, and it never feels like you've done enough. But I assure you we have, and our clients are in much better shape than they would have been had we done nothing over the last 12 to 18 months. So where do we stand today? We have made the comment in some of our writings that it's too late to sell, but it's too early to buy. That seems like we're talking out of both sides of our mouth, but it's how we actually feel, in that we've had a 30% decline up until 2 days ago in 3 weeks. That decline has come without any earnings releases from companies. It's come without any economic forecasts or economic data being updated. So we had a substantial decline. And in that decline, the level of volatility has increased very, very dramatically. One index I look at all the time is called the VIX, and it is the volatility index in the options market. Given that volatility index, it hit 80, and it was trading around 12 at the end of last year. The last time it hit 80 was in December, or actually early October of 2008. Now, at that time, the market hit a near-term bottom in 2008 and then traded up and traded down with a lot of volatility. But when you look at that October till the end of the following year, till the end of 2009, the equity market was actually higher. Did it go lower between October of 2008 and the end of 2009? Yes, it did. The final low was in March. But if you had the time horizon and it was long enough to just sit and wait, you actually were whole again from that October low by the end of 2009. So we are aggressively looking at when we need to be back into this market. We don't think it is yet. We are looking at individual securities and trying to pick our points of where we want to buy them and get people more aggressive again to come out the other side of this. But we think that once we see earnings announcements come and revenues and earnings from many companies, we're going to see a retest of the lows. So one of our messages is we tend to make incremental moves in this market. We don't jump in one day or out the next, but we try to move methodically and purposefully to buy securities that we think are attractive at a certain price for the next 2 to 3 years, not the next 2 to 3 months. And we are finding those opportunities now, but we do think that once we see earnings announcements that we're going to have an even better opportunity to buy these securities at lower prices. The one thing we do struggle with is just the levels of the market. Up until 2 days ago, the S&P 500 was down 30%. As I look at the market today, we've had a substantial rally. And today, the year-to-date number on the S&P is down 20%. So we've had a 10% improvement in the year-to-date numbers in 2 days. That is extreme volatility, right? A 10% move can be an entire year's move, and we've had it in 2 days. So we're going to make incremental moves as we go forward. It is, very interesting. We have many clients in many different industries and many stages of their life, and we have some clients that are scared and want to sell. We have other clients that are saying, you got me conservative, get me back in. It's time to get back in. We are trying to sit on our hands and not make aggressive moves. because this market can make you look very stupid in a very short period of time. If you would have sold 2 days ago, you would look not smart today. And if you were buying today, we could be down again 10% in 2 days, and you could look not so smart by jumping in. So we will continue to make incremental moves. We will buy companies that we think are attractive at certain times. To give a little context, the S&P 500, the earnings forecast for the S&P 500, the broad index, for next year is $153 a share. It's selling today for about 15 times that number. We think that number needs to come down. It's not going to be $153 a share. It's going to be somewhat lower than that. So where do we think this market can head, and what kind of numbers can we put around this? We looked at the last 10 years, and the average earnings of the S&P 500 was $122 a share, and the average PE multiple on those earnings is 18 times. That gives you a value of the S&P of about 2,200. Today, it's 25.40, but 2 days ago it was 22.30, or 2 days ago it was 22.37. So while we think that down 30% was a near-term low, we do not think it is the ultimate low. We will see earnings announcements coming over the next 2 quarters, and we will know much more as companies respond to this. So I will say one other thing. There are many companies that are doing well in this period. You can look to Amazon, who's doing exceptionally well with online deliveries. You can even look at names like Target and Walmart, who have responded to these situations and are doing delivery and pickup. Even a name like Home Depot is managing through this process very well. So there are names that are continuing to do okay. The biggest trouble areas are definitely travel with the airlines, hotels, and cruise lines, obviously, and that will continue for probably some time. Some of these companies will be bailed out. I don't think earnings or airlines and hotels are all going to go away, but some companies will fail and struggle as well. So what are we looking for? We are looking for companies that have good balance sheets, that no matter what happens over the next 2 weeks or 2 months, they will be able to withstand the downturn and come out the other side. And those are the companies we're focused on. Companies like Medtronic, or many of the pharmaceutical companies, or the utility companies. We're focused on these companies that have strong balance sheets, that have stable earnings, and will make it to the other side of this right now. That is not to say that they will be the best performing companies as we come out the other side. It's been my experience over the last 33 years that in times like this, some of the best performing stocks are the companies that have peered into the abyss of bankruptcy and not gone under, and they perform the best because they're levered and the upside is tremendous. We're not ready to take those types of risks yet. We don't know who's going to make it through, but we do know the companies that have good balance sheets, and we're focused on those, and that's where we will continue to look for opportunities with companies that have stable earnings, good balance sheets, that are selling at really attractive prices, and prices that we haven't seen for many, many years, and that's what we're going to be focused on as we move forward. Those are my general comments. I'll have more in the Q&A. I'll wrap it up by saying in my comments what I said before. It is too early to start buying, but it is too late to sell. As long as your time horizon is 1 to 3 years out, we will make it through this period. The market will be extremely volatile, but we will come out the other side. With that, I'll turn it over to John Lynn, our senior fixed income analyst and portfolio manager, to talk about what's going on in the fixed income markets.
Well, thank you, John. I think it's fair to say at this point in the game that just about no asset class has been really completely unaffected by the fear and uncertainty surrounding our current economic conditions. The fear and volatility that started in equities has, spilled over the last couple of weeks into kind of manifesting itself into a liquidity crunch in fixed income markets. So in other words, there was panic selling that overwhelmed demand. So we've seen yields rise really across all fixed income asset classes, and I'll try to kind of touch on each of the ones that we focus on here to give you a little bit more color. But before I start with that, I will mention that, in these times when we're seeing, as John was talking about, 10% up days or 10% down days becoming kind of the norm for equity markets, conditions really shift, not just on a day-to-day basis, but, also on an hourly basis for some of these markets. So I'll start with the corporate bond market. We've seen corporate bond spreads widen sharply, moving prices lower and yields higher. We're not very active in the high yield sector, but just for instance, the BB rated yield curve has flattened significantly. We've seen spreads widen 200 basis points on the long end and around 600 basis points early on. So, particularly affected sectors like energy, airlines, hospitality, those have shown some of the most weakness, as we would expect, when there's uncertainty around the economic impact, with so many population centers around the country being shut down. So there's obviously some elevated credit risk concerns in the high yield sector of the market. That's where the companies are the most leveraged, and the company financials are the weakest. So that being said, our taxable strategy really focuses more on higher credit quality and an overweighting to relatively safer sectors. We've targeted companies with strong balance sheets and credit metrics. So while we've seen pricing weakness in our portfolios, it generally fared far better than, some of the areas that investors have been pulled into, really stretching for yield by moving into riskier products and down the credit spectrum. So we've largely avoided that temptation over the last few years, and we think that it's really benefited portfolios well. What has the change in yields meant for us? Just a couple of weeks ago, we were buying bonds in that 5 to 7 year range, which we really view as kind of a sweet spot on the curve. And we were seeing yields anywhere from 2.25% to maybe 2.5%. Well, now we're seeing good quality bonds approaching and above the 4% level, in the lower end of that range. So yields have really moved pretty significantly, but what I will say is that while the previous 2 weeks were very active, where we saw yields bump up and prices really depressed, so far this week, and I'll discuss a couple of factors that have played into that, we've really seen a stabilization of the market, and actually yields start to turn a little bit lower again. So to address the muni market, AAA rated muni benchmark yields over the previous 2 weeks made some historic single-day movements higher. 10-year AAA rated benchmark yields rose from about 86 basis points to 2.6% yesterday. That's a huge move in 2 weeks. Now, that being said, rates are lower today probably by about 30 to 40 basis points across the curve. So, as rates increased, we have seen buyers coming back into the market. But really the reason for that huge move that we saw, is after a year of straight weekly inflows into mutual funds, everybody ran for the exits all at once out of fear to raise cash, and the market was just overwhelmed by the volume of bonds for sale to meet those redemption requests. So this was really a liquidity event for the bond market, not a credit event. That said, states and local governments we feel will be affected by a recession. Typically, the effects lag by a year or two. As in past recessions, though, municipalities are resilient, so they have taxing authority and budgetary flexibility to get them through economic cycles. We see this as no different. And in addition, I think that the economic activity that's maybe slowing in parts of the country right now could be, I think, softened by some of the actions that the Fed has taken to increase aid and support to municipalities. So we just don't see a widespread inability to continue servicing debt for high-quality issues, which are the bonds that we've been investing in for client portfolios. As I mentioned, so far this week we have seen a stabilization and even a slight uptick in bond pricing as demand has finally caught up and the rash of selling has slowed. It's possible that what I heard yesterday, and I really kind of love this term, was somebody referred to the recent buying as panic buying, which is kind of the opposite of panic selling, but really as opportunistic investors like us have been jumping into the market to try to take advantage of these higher yields before the market finds its footing and returns to some degree of normalcy. So after the Fed announced backstops and a stimulus bill looks to include support for the market, I think we've actually seen that happen. But frankly, it's shocking to see bond prices fall by dollars in a matter of days and weeks, particularly when investors have become accustomed to seeing nothing but rising prices for years on end as rates fell to zero. The flip side to that shock, though, is that we've had a tremendous buying opportunity here for investors now in taxable bonds, corporates, as well as tax-exempt bonds. And investors that have really been starved for any kind of real yield on their money the last 2 years. So, on the fixed income side, we do see reasons for optimism. As I noted, the Fed is committed to bond purchases to help stabilize the credit markets, which is a positive. The Fed now has a program in place for buying short-term securities to support money market mutual funds. That's all helped to stabilize pricing. I think the bottom line here is that liquidity mismatches, like we've seen in the market the last couple of weeks, are bad for sellers, mainly mutual funds and anybody that was panicking to raise cash, but they're good for buyers. So this has been a tremendous opportunity for us to, invest in bonds at rates that we just haven't seen for years. I think lastly, I just want to emphasize this. The type of environment that we've seen is exactly why we structured portfolios the way we have, using high-quality individual securities with defined maturity dates rather than using long-duration, open-end mutual funds. The vast majority of our clients' portfolios have bonds returning principal from maturities in coming months and years, and that was exactly by design to take advantage when rates rise like this. Those were my general comments on the bond markets. I think that said, I would turn it back over to Ron for any questions on anything I might have said or maybe not touched on. So, Ron, I'll hand it off to you.
All right, John, thank you. Why don't we go into some questions, both on the equity markets and the fixed income markets. John Schoenberg, we've talked about that it's not time to sell, but at the same time, it may not be time to buy. But as you talked about, we spent the last 18 months de-risking portfolios with equity prices going higher. How do you view buying when the market is so volatile and maybe even headed lower?
Ron, I think as we go forward here, we will be making moves when we see severe price dislocations relative to what we think are good fundamentals in a company for the next 2 to 3 years. People have a tendency to extrapolate current events for a long period of time. Just like we saw on the way up, companies raising and beating earnings time and time again, and the market keeps going higher and stocks keep going higher individually. I think we're going to enter a cycle here where we get some negative news and you start to see individual stocks respond to that news, and analysts that follow these stocks have a tendency to take the near term and make it long term. Just like they did on the up, we think they're going to do it on the down as well. So what we are really focused on is quality companies that we think are leaders in their industry, that are going to be around for the next 10 to 20 years, that are secular growth companies, that are leaders in their industry, and we're going to look for a mispricing of those securities as people take the near term and think it's going to be that way forever. So, we tend to look at things stock by stock. We have calls Tuesdays and Thursdays where we get really in depth on individual securities that we're looking for. We have our lists of names to buy, and we have price targets. And if we think we see a company that is selling below what we think its long-term value is, we will start buying that security in clients' accounts and position them for the next 5 years, not the next 5 months. So it's a stock-by-stock building process. You won't see, major buying and selling. You never see that in our accounts. You see incremental moves, and you will start to see us move incrementally back into good quality securities that are selling at really attractive prices, and that's what we're going to be focused on.
All right, thank you, John. Heidi, we haven't had you involved yet, but I do want to ask you a question. You've been managing bond portfolios for many, many years. Why is an allocation to bonds important in client portfolios?
Well, thank you, Ron, and thank you all for all of your comments. They've been right on. Bonds have always provided income and stability to a portfolio. It's not as attractive in a long bull market as we've had, but the past 2 weeks show exactly how important an allocation to bonds are. For example, the maturities, we have a fairly short duration on our bond portfolios, so we have a lot of maturities coming up. The bond portfolio of Stonebridge and our client portfolios, we've got about $10 million in bonds coming due in the next few months. This not only provides income for the portfolios, but it also provides liquidity so that the clients do not need to sell equities in these negative markets. They can be looking to the bond market for the liquidity. It also is giving them an opportunity, or giving us an opportunity to buy on their behalf, either bonds at these increased interest rates or increase their allocation to equities, as John was saying, on an incremental basis. So really, really important to buy bonds and have bonds as an allocation in a portfolio to add stability and income to those portfolios.
Great. Thank you, Heidi. Bob Kincaid, we haven't had you involved yet, and I do want you to make some comments because as all of the clients and advisors are hearing from our portfolio management team on this recording, it really is important that you address how our entire portfolio management team, which is made up of experienced and often opinionated research analysts and portfolio managers and traders, how do you incorporate all of those opinions and then include Dan's economic forecasts when we're creating investment strategies and managing individual portfolios?
Thank you, Ron, and thank you to all the other panel members. This could be a long answer to a short question. but I'll try to summarize it as best I can, as I think our panel members have done so. It has always been our philosophy since the day we opened our doors at Stonebridge that the client's interests and needs and objectives come first. So when we set an investment strategy for a client, it starts with their goals, needs, and objectives. We establish the strategy for that client, be that through asset allocation, the types of securities that they want to see in their portfolio, and even to some degree, the restrictions that they have on certain securities in their portfolios. Or we may have consolidated securities, or we may have specific interests of the client that they prefer not to invest in certain sectors or certain individual companies in their portfolio. We take all of that into consideration when we meet with our clients. It is the portfolio managers that meet with the clients to set those goals and objectives, and then design the strategies very specifically with individual securities that are selected specifically for that client. And so every client portfolio will look a little bit different than the next, and the difference in how they look is solely based on what they need to accomplish with their portfolio. Now, how we combine all of that information with the research and analytics that is done by the team, as well as the outstanding economic forecasting that Dan has done for a long time, he is one of the best in the industry, is we take that information, look at it, analyze it, and how it pertains to each one of our clients, and then apply it there. And as we go back through an example of that, I would take us back to the first quarter, beginning of the second quarter of 2019. Dan laid out an economic scenario that indicated we were very likely going to have a recession in early to mid-2020. His equity indicator was starting to turn negative. And through the research and analysis that our portfolio management team did along with Dan's expectations, indicated to us that we were at the topping process of a bull market and a bull economic market that had been in place for the better part of 10 years. And as Dan stated earlier, bull markets do end at some point in time, as recessions do end at some point in time. So as a team, we looked at that information and then applied it to each one of our clients' portfolios. We went back to our clients, recommended that this was a time frame that we start to reduce the risk in their portfolios by reallocating the portfolio, reducing the holdings in equities and moving them into fixed income securities and or cash. And that allocation percentage was done very specifically on each client's individual portfolio. So we may have clients that were more risk-oriented. They may have had a very high allocation to equities, maybe 90 or even 100% of their portfolio, where we made recommendations for them to consider reducing that equity exposure to 80%, 70% in some instances. And then there were other conservative clients who may have been 60 to 70% invested in equities. We may have advised to them at that point that they reallocate their portfolio to an allocation closer to 40 or 50% equities. But it was done on a client-by-client basis. As we move forward through 2019, the indicators continue to tell us that we are in the topping process of a bull market and that we should be prepared for the next stage of that market. And Dan's economic forecast continued to indicate that we were expecting a recession in 2020. And we then looked at all of our client portfolios, and within the equity portfolios, decided to take some sector rotation moves to protect our clients from the downside of a market and the topping process. And so we looked at the sectors of an equity portfolio that do better at the end of a market cycle. That might have been technology, healthcare, finance, and staples. We also took a look at the sectors that are at more risk at the top of a market cycle and reduced those slightly. in addition to reallocating equities slowly out of equities into fixed income. On the fixed income side, as John has aptly pointed out, and Heidi, as we looked at what the market was telling us relative to a slight inversion of the yield curve in 2019, we saw that the spread between high yield or junk bonds and high quality, lower yielding, high quality bonds was narrowing. It gave us an indication that the bull market on the fixed income side was also coming to closer to an end. And so we took a look at our portfolios. We took the gains that we could in the high yield and junk bonds. We also reduced our holdings in longer term fixed income securities and bought high quality, lower yielding, shorter maturity fixed income securities to protect our clients on the downside of the fixed income market. As we entered January of 2020, it was even more clear that the market was at the top of the market cycle. It had risen rather dramatically in the first few months of January, which caused us on the equity side to slow down any purchasing or nearly stop any purchasing of equities at that point in time in anticipation of what the next stage was going to be. On the fixed income side, we continued to take more defensive actions by shortening our maturities and creating more cash in our portfolios. But all of that action was taken very specifically relative to the client's individual objectives and needs. And so each client had their riskless movements according to their objectives. As we entered February and the coronavirus, things moved very, very quickly. As John aptly stated, this is the fastest movement we've ever seen in the equity markets and fixed income markets in history. And the decline was rapid and painful. We have had a brief break in that here in the last couple of days relative to actions taken by the federal government, state governments, the Federal Reserve, and the U.S. Treasury. They have moved very, very quickly, and I must say I applaud them for their actions. Their attempt is to try to minimize the downside of this recession, which Dan has accurately stated we are likely in right now. The numbers will prove it as we get to the end of the first quarter. But it is important to keep in mind, as historically has been the case, a drop in the equity market, or the equity markets in general, are a lead indicator. By their drop, they have told us we were headed for a recession. And it is very likely that we now are in the next step in this market cycle, which is the bottoming step. And very likely may see a bottom in the stock market here in the next month or two. Now, this bottoming process is not much different than the topping process. It will be very, very volatile. We'll have big up days and big down days. But we will use this opportunity to talk with our clients about now rebalancing their portfolios in anticipation of the end of the recession, the end of the bear market, and how they want their portfolios allocated in the event that is the case. And so that bottoming process is something that will take some time. We will be very slow and specific about how we meet that opportunity with a careful selection of securities that we believe will do well as we move out of the recessionary time frame and benefit the clients with those reallocations, but in accordance with their investment objectives. So that's where we believe we stand today. We anxiously await the opportunity to talk to you, and we'll be contacting you about your portfolio and how we can walk through this process. But it is something that we'll do diligently and with the appropriate amount of time frame to make sure we're making the best decisions for our clients. So with that, I just want to say thank you for for being with us. We appreciate this opportunity to talk with you about the economy and the markets and our plans for how we will work with you in moving through to the next stage of this market cycle. Ron, I'll pass it back to you.
All right, Bob. Thank you. You know, over the last several years, the investment industry has continually moved towards passive index investing, sector ETFs, robo-advisors, mobile trading apps, packaged products, and now the race to zero in commissions. At the same time, we've seen the registered investment advisory space continue to grow, and Stonebridge thinks there is a bull market for advice. Bob and all of our portfolio managers have laid out what we think makes us different. We appreciate all of you, and on behalf of the entire Stonebridge organization, thank you for listening.